Thank you for tuning in. Dividend Dashboard here, and welcome to another portfolio update. This episode is a special one because it marks the first portfolio update after ending my 6-month career break. I got a new job and contributions are rolling in. For those who are watching for the first time, welcome. As usual, in this type of videos, I go through the stocks I bought, dividends received, and a portfolio update in full transparency. So with no additional fluff, let's dive in. For this month, I bought 5 businesses: Hershey's, Texas Instrument, Automatic Data Processing, Google, and Microsoft. The combination of selling some positions and contributions starting again has allowed me to buy several shares. For Hershey's, my largest holding, I bought 0.27 shares, just a regular dollar cost average. For Texas Instrument, I increased my holding by 1 full share. I know TI's cash flow has been reduced heavily due to the increase in capital expenditure in order to create a chip mega factory. This reduction in cash flow is temporary. Despite being in a cyclical business, over the long term, the company continues to grow and expand. For Automatic Data Processing, I bought 1.74 shares. This is a HR solution business, but I view it from a data standpoint. Data in today's era is valuable, and being the leader in this type of business gives us a huge scope on how the job market is doing, which is essential for a healthy economy. This is not the best tech stock to own, but the growth is extremely consistent in the high single digits. For Google, I've been on a buying spree. I bought 3.10 shares. Google is a no-brainer in my opinion. The company is trading with a low PE multiple while every revenue segment of the business is growing double digits. So why is it trading down? Well, investors don't like when companies spend huge amount of cash flows. In this case, Google is investing heavily in AI, which I see it as a good investment for their existing products. Under $200 per share, I'm extremely bullish on Google. And the latest addition to the portfolio, Microsoft. I started this position by buying 1 full share. Microsoft is a high quality business that despite being in the trillions market cap, this company is still growing double digits. Just like Google, Microsoft is also investing in AI, and I'm sure it will benefit them to scale their products to a new level. I want Microsoft to be one of my core holdings in the future alongside Google, Visa, and MasterCard. Moving on, 9 companies paid me a dividend. MasterCard, $2.59. Texas Instrument, $8.16, Apple, $1.17, Colgate, $4.19, AbbVie, $9.87, Clorox, $6.11, Realty Income, $5.79, Procter & Gamble, $3.05, and Starbucks, $11.18, for a total amount of $52.11 in dividends for the month of February. Worth mentioning that this is the last Clorox dividend in my portfolio, as that was one of the companies I sold to continue high-grading the portfolio. For the dividends year over year, February has seen substantial growth. 2020, $0. That's right, back in 2020, I had 0 dividend income. I haven't even received my first dividend yet. 2021, $5.09, a small but exciting first step. This was when the snowball started rolling for this month. 2022, $20.84, a big jump from the previous year. At that time, I had low quality high dividend payers like AT&T. 2023, $38.25, another solid increase, showing the power of consistent investing and dividend reinvestment. 2024, $45.40, a slower growth, but still moving in the right direction. The deceleration was due to quitting my job halfway 2024. In 2025, $52.11, my highest February dividend income yet. This steady growth shows why I love dividend investing. The power of compounding, reinvestment, and consistently adding to my position has helped me push my income higher each year. Now that I started contributing again in 2025, the compounding will continue. You might notice that the companies that I'm buying now have a lower payout but double-digit dividend growth, which means that the year-over-year growth will slow down short term, but long term it will explode to the upside. Low starting yield with double-digit growth is better than high yield and single-digit growth when we view it long term. I can probably make a video on that topic. If you want, let me know in the comment section below. Moving forward, I have a portfolio valued at $25,282.81 with $250 in buying power. Weighted dividend yield sits at 2.74%, which translates to $543 in projected annual dividends. The portfolio has 21 holdings. Performance-wise, is doing great with a 6.75% year-to-date performance. As mentioned, the portfolio consists of 21 businesses that allow me to get closer to my financial goals day by day. Going clockwise, I have Apple, Colgate, Realty Income, Procter & Gamble, Waste Management, Kroger, Starbucks, JP Morgan Chase, Home Depot, Johnson & Johnson, Nike, Digital Realty Trust, AbbVie, Texas Instrument, Hershey's, Pepsi, Visa, Automatic Data Processing, MasterCard, Google, and Microsoft. I built this portfolio with a focus on companies that not only pay dividends but also grow them over time. Some of these are dividend aristocrats, others are high growth dividend stocks, and a few are recent additions I'm still building a position in. I want this portfolio to be diversified in the extent of doing great in any market condition while receiving a fast growing dividend year over year. I believe it's achievable and I will continue working towards that. One of the best things about dividend investing is watching your passive income grow over time. Every share I own works for me, paying out dividends that I can reinvest and compound over time. Here's a breakdown of my current annual dividend income by stock. This updated breakdown shows me exactly where my dividend income is coming from and where I might want to focus on adding shares. Right now, Hershey's, Realty Income, and Starbucks are some of my highest dividend payers, while Microsoft and Alphabet, Google, are on the lower end as more growth-oriented holdings. One thing I love about dividend investing is how predictable and reliable this income is. Whether the market is up or down, these companies continue to pay and in many cases increase their dividends over time. Not only dividends make the portfolio grow, but also the return of my holdings. We can see a combination of big winners, but also a few losers. Tracking total return is important because it gives me a full picture of how my investments are growing, not just from dividends, but also from stock price appreciation. Despite having some losers, the portfolio is still growing. Most of the famous investors out there had several losers too, but some of the selected stocks they had turned out to be amazing investments and carried their portfolio to an extent that it covers for the companies that are in the red. The stocks that are currently in the red, I still believe in their long-term potential. In fact, I've been adding to some of these positions as I see them as opportunities rather than failures. So that will be it for this portfolio update. If you made it onto this part and you want me to continue making these monthly updates, all you have to do is like and subscribe. Thanks for watching, and I'll see you in the next one.